Everybody wants venture capital money. The pitch decks, the seed rounds, the headlines. We just raised $10 million. dollars. It looks glamorous, doesn't it? But here's the truth they don't tell you. Venture capital can make or break your startup, and most of the time it breaks it. Welcome to Startup Sensei. Today we're exposing the ugly truth about venture capital, why it's not free money, why it's not always smart money, and how taking it too early can actually kill your business before it even begins. Let's start with the illusion. When you see a startup announce a big funding round, you think, wow, they made it. But that announcement, it's not a victory, it's a contract. A contract that says, we just sold part of our company in exchange for pressure. Because when you take VC money, you're not just taking investment, you're taking expectations. They want 10 times returns. They want speed, not sustainability. And suddenly your goal shifts from building something great to growing something fast. That's how founders lose control. Here's the first ugly truth. Venture capital doesn't fund your dream, it funds their timeline. Your investors don't care about your 10-year vision if it doesn't fit their 7-year exit. Their business model isn't your product, it's your liquidity event. They make money when you sell or go public, not when you succeed slowly. That's why you see startups raise, grow too fast, and then collapse. The founders building a company, the VCs building a payday, and when those goals collide, guess who wins? Second truth, VC money magnifies everything, including your mistakes. If your business model's weak, money won't fix it, it'll just break faster. If your product isn't validated, funding turns small problems into million-dollar disasters. Because when you have cash, you spend. You hire too fast, you build too much, you scale before you're ready. And before you know it, you're running a company you don't even recognize anymore, bloated, confused, and burning cash like rocket fuel. Third truth, when you take money, you lose control. Let's be honest, owning 100% of a small business sounds less sexy than raising $50 million. But here's the thing. A founder with control builds freely. A founder with investors builds under supervision. You can't pivot without approval. You can't slow down without explanation. You can't say no when someone's holding the checkbook. The company stops being yours. You'd be shocked how many founders built incredible products and then got fired by their own boards. That's not failure. That's ownership erosion. Fourth truth, VCs don't invest in ideas, they invest in momentum. They'll tell you they love innovation. But the reality, they chase traction. If your growth graph isn't bending up and to the right, they're out. If you're not going viral, they'll ghost you. And the moment your momentum slows, they stop picking up your calls. That's why the best founders never depend on investors. They build leverage first. Customers, revenue, community. Because when you have leverage, you choose your investors. They don't choose you. Now, this doesn't mean all VC money is bad. Far from it. It's rocket fuel. But only if you already have a rocket. VCs are incredible when your product works, your users love you, and you're scaling. But if you're still figuring things out, their money will set your timeline on fire. You'll go from finding product market fit to meeting quarterly growth targets. And trust me, those are two very different games. Here's the fifth truth. VCs fund outcomes, not effort. You can grind 80 hours a week, burn through your savings, and build something extraordinary. But if the metrics don't show exponential growth, they'll move on. You're a founder. They're portfolio managers. They don't need you to win. They just need one of their 30 bets to win. You're part of a spreadsheet, not a partnership. That's not evil. It's math. So what's the smarter way? Build leverage before funding. Build proof before pitches. Build something people pay for before you ask for money. Because once you have revenue, once you have customers, you don't chase investors anymore. They chase you. Then you can choose the right kind of capital. Not desperate money, but aligned money. Look for investors who bring more than cash. The ones who bring distribution, relationships, experience. People who see your vision, not just your valuation. And don't just take their money, take their time. If they won't spend time with you, their check's not worth it. Here's the Startup Sensei truth. Raising money shouldn't be your goal, raising value should. Because capital doesn't make you a founder, customers do, revenue does, impact does. Money amplifies what's already there. So make sure what's there is worth amplifying. So the next time you see a founder celebrate a funding round, remember this. It's not a finish line, it's a fuse. And the founders who win, the ones who build real, lasting companies, aren't chasing VC money. They're chasing freedom. Freedom to grow at their own pace. Freedom to build something meaningful. Freedom to say no when everyone else says yes. That's the real power move. So take money if you must, but only when you don't need it. That's when you're ready.